This is the BiggerPockets podcast, show 497.
I was learning how to underwrite at the time, and I was underwriting all these smaller properties and looking at the numbers. And I was like, wow, I have to go through all this, take this risk, go through all this effort, and look at the small amount of money that's going to generate for me every month. And that was a little bit discouraging. And then I noticed that, hey, when if instead of looking at a duplex, if I look at a 3-unit or a 6-unit, look how much better that looks. Like I'm going to go through the same process, but wow, now it's actually something that could make a difference for me.
You're listening to BiggerPockets Radio, simplifying real estate for investors large and small. If you're here looking to learn about real estate investing without all the hype, you're in the right place. Stay tuned and be sure to join the millions of others who have benefited from BiggerPockets.com, your home for real estate investing online.
What's going on, everyone? It's Brandon Turner, host of the BiggerPockets podcast, here with my co-host, Mr. Metaphor of Multifamily, David Green. What's up, man? How you doing?
Nice alliteration. I'm doing really good, actually. Things are going pretty well.
Brian Murray, you're here as well right now. We got you for part 2 today. What's up, man?
Hey, how you guys doing? Really excited to dig back in here.
Well, for those who don't know, if you didn't listen to the last episode of this podcast, which was episode 496, we spent like over an hour just going through small multifamily properties, kind of a step-by-step guide to buying small multifamily. And we talked about what the difference between small and large is. It's not unit number, and a whole lot more. And we really dove deep into that. And then we ended that with me reading chapter 1 of the new Multifamily Millionaire book. So today we're talking about large multifamily, and that could be a 5-unit. Technically, it's the way you approach it, as we talked about in the last episode. It could be a 20-unit, could be a 50-unit, but the idea of how do you scale into like a team-based approach to big deals that can really create some generational wealth. So that's what today's episode is all about. And Brian, you're going to be leading the charge on this because you led the charge on writing volume 2. I kind of led more of the writing in volume 1. You led more of the writing in volume 2, but we kind of did it together, tag teamed it, which is fun. So I'm excited about this. Should be a good time. And before we get to that, though, we got to hit today's quick tip. Today's quick tip is the exact same quick tip as I gave on the other show. Pick up a copy of Volume 1 and Volume 2 of the Multifamily Millionaire when you get it at BiggerPockets.com/multifamily book, MULTI family book. And when you buy them together, you get like 10% off, and you get a bunch of cool bonuses, like which are worth more than just the cost of the book. And if you buy it before the end of August 2021, we're also tossing in the 4-week masterclass that I hosted on multifamily, where I spent almost 7 hours going through the book in detail, a bunch of the chapters, and really like it was like me, a whiteboard, a slide deck, and I just dove into it. So all that and more, if you buy it before the end of August, again, BiggerPockets.com/multifamily book. It's time to get into the weeds of large multifamily. Brian Murray, what's up, man? Welcome back, and thanks for joining us.
Absolutely. Excited to be here again.
I know you are, right? Anytime we hang out, we're excited, right?
That's right. Especially when we're talking about multifamily.
We're kind of like multifamily nerds, aren't we? It's a good thing to nerd out about. Somebody once said, by the way, it was Warren Buffett once said, I'm going to butcher the quote, but he basically said, I could have been really excited and interested in like janitorial work. I just happen to be really interested in something that makes a lot of money. And I found that such a profound statement. Again, I know I butchered it, but the idea being like, I could have been really good at like underwater basket weaving and interested in it. I'm just so glad I got interested in multifamily, that my fire is in multifamily. And I know, Brian, you probably feel the same way.
Yeah. It gets me charged up.
Yeah. Well, let's do this thing. David, any thoughts from you before we jump into the step-by-step of large deals?
Well, the first thing I want to ask Brian here is, why should I be interested? What is the appeal of multifamily investing?
Wow. So there's a lot of reasons why I get so excited about multifamily. And, in the last episode, I made a reference to the fact that it's forgiving. And so I want to touch on that again, because I didn't really expand on that. And,
please.
I think there's a lot of reasons it's forgiving, but one is that with large multifamily, your income is spread across so many different tenants, right? So if you make a mistake with a tenant, with a single unit, if you've got 100 units, you're talking about a 1% drop in your income, right? Even if you mess up with 3 tenants, okay, but with the other asset classes, say commercial or retail, oftentimes if you mess up with a tenant, you might be cash flow negative and really dig yourself a hole. So the consequences of that mistake are magnified for other asset classes. Multifamily, I also love the people, right? I love that aspect of it. A lot of people think it's easier to work with commercial tenants, retail tenants. I've met awesome people who are retail and commercial tenants, but I've met some of the most difficult tenants I've ever dealt with are professionals who maybe frankly sometimes come across as super arrogant and demanding. And but with multifamily, we get so many down to earth good people, and I know I personally feel really good about providing good quality housing for them. I mean, we oftentimes in my company will refer to them and Brandon at Open Door Capital. It's like we call them homes. That's what they are. They're people's homes, and the larger you get, you got to have that motivation and that inspiration, and providing great homes for people can, something you could really feel good about.
Hey, Brian, I have a question for you. Why did you not start with the smaller deals like I did? I started with the small, like a lot of duplexes and triplexes and like that small world. You kind of jumped right into the bigger stuff. Why is that?
It really had to do with, I was doing the financial analysis, and I was learning how to underwrite at the time. And, I was underwriting all these smaller properties and looking at the numbers. And I was like, wow, I have to go through all this, take this risk, go through all this effort, and look at the small amount of money that's going to generate for me every month. And that was a little bit discouraging. And then I noticed that, hey, when, if instead of looking at a duplex, if I look at a 3-unit or a 6-unit, look how much better that looks. Like I'm going to go through the same process, but wow, now it's actually something that could make a difference for me. And then as I got even bigger, I remember I came across one property that a broker came back to me and was explaining to me, hey, there's an opportunity. You could potentially get into this larger property because the seller owns this outright and is willing to do owner financing. And I was like, what are you talking about? Like I kind of figured that out. And I realized that the bigger you go with the properties, the more common it is to have creative financing opportunities. And that got me really juiced up, because then I realized that, hey, I thought that the savings that I had wouldn't go very far, like that I couldn't be looking at big properties. And what I realized is it was in many ways just the opposite, because the bigger you get, there's all these what seemed to me at the time to be these crazy ways to finance it and structure it so you could get into them with less money. And then it's still looking at that underwriting, and I get to that bottom line and I'm getting really excited because I say, hey, these big properties could throw off a lot of cash and really make a difference in my life. So yeah, that's kind of the process I went through. Even before I bought that first property, it kind of evolved as I analyzed more and more deals. And it just so happened that one of those larger deals landed, and it helped me kind of reframe what I thought I could do. And I know I think it's in the very first chapter in volume 2. We'll talk maybe later about the myths, but there are a lot of myths that people have, and don't need to go into those right now. But I think the bottom line is, like, I'm really passionate about explaining to people why they don't, all those reasons they think they can't get into multifamily, you really can. There's so many ways to go about it, and I love that.
Let's say that I'm sold on that and I want to start in multifamily. What skill sets do I need to know I'm ready to start at that asset class?
So I definitely don't think anybody should just dive right in without doing any homework or like laying some groundwork. I mean, if you're already investing in small multifamily, I think you're more prepared than you think you are. What is a 100-unit apartment complex? It's the same as if you have owned a single condo, how challenging was that for you to manage? And most people could wrap their heads around that. And if you can wrap your head around how to manage a single unit, why couldn't you manage 100? Right? It's just volume. It's not a different process necessarily. It's just volume. So yeah, I think that I want people to know that it is an option. It's real. You can do it. And that's what the Multifamily Millionaire Volume 2 is all about. It's not saying that large multifamily is for everyone. It's saying that it's an option, and it's making sure that you understand that it's an option you can choose if it's right to you, because there is a way to do it. And most of those reasons why you think you can't, there's actually ways around them.
That's cool, man. Well, one of the things I love about the larger multifamily, I just want to throw this in as well. There's a lot of things I love, but I love the fact that it is a business and it feels more like a business. I mean, it's the same game we talked about in the last episode. It's the same game as small multi. Like, you're still dealing with tenants, like you said, 1 unit versus 100. It's not much different, but the approach to large multifamily is so much more similar approach to, like, if you own a chiropractor business, or you own a McDonald's, or you own a Starbucks. Like, it's a business. You have goals, you have people, it's got personnel, you've got personalities in there, but it's this, like, the same business principles as almost any business apply to the larger multifamily. And the reason I like that is because it's designed to be a business that you don't have to be 100% a part of every single piece. In fact, I would say it's easier to own and manage a 100-unit property than it is a duplex. That sounds crazy, but if you build the right systems, which is all what Volume 2 is all about, is how to do that. It is less work to manage and to own and to buy a 100-unit than it is a duplex. Yeah. Maybe not to buy. I mean, buying a duplex can be pretty easy, but everything else,
absolutely,
it's kind of crazy.
Absolutely. And while I encourage everyone, and I'm saying, hey, you can do it, that doesn't mean you do it alone, right? So then I think you're alluding to that too. And I think an important characteristic for someone who's even thinking about jumping right into large multifamily is you have to have some humility. You can't be unrealistic at the same time. I don't want people to be afraid of it, but at the same time, if you walk in, like thinking you've got a cape on and wearing your underwear on the outside of your pants, like you're gonna
which I do,
you're gonna fail, right? So having some humility and saying, hey, here's where my skill sets are, here's where my knowledge set is, what do I need to surround myself with to do this? That's the right way to go about it. So those people who've jumped in and they're jumping right into large multifamily, they're usually very self-aware. They're humble. They say, hey, I want to do this. I know I can bring some value to the table, but I've got to partner with somebody who has maybe done this before, or they've got something I don't have. I think that's part of why, Brandon, you and I gravitated to each other to start Open Door Capital. Like, we both brought different things to the table, and whereas these books formed on the side of a volcano, Open Door Capital started with, I think the first time we agreed to partner, we were sitting on surfboards, and
I think so.
We were both planning to go into large multifamily at the same time separately. And we recognized that, hey, if we do this together, we could go so much further together than either one of us could on our own. And, I think there's a lot for people to learn from that.
Do you remember? I remember one of the very first conversations we ever had about possibly working together. And again, brings back the idea of the team-based approach. Multifamily is a very team-based approach when you get to this larger level. But it was in the back. You were in the back of Ryan's van, which has no seats or seat belts. And we were driving around Maui. Do you remember that? It was at the Maui Mastermind. And it was either you or me were in the back of Ryan's van as we're driving around doing something, and we didn't have enough seats. Do you remember that?
Yeah, absolutely.
So we're going to say that our multifamily partnership started in Ryan's crappy white van. It's great. All right.
Good stuff.
So good stuff. And so let's dive into that. I wanted to go really step by step today. David, you and I talked about this earlier, but we want this episode to be a step by step. If you want to get into the larger multifamily, this is what you got to do. And we did it last episode on the small multifamily side. So this one, we want to go the large. So unless, David, you have any objection, why don't we just get into number one? Is that cool with you guys?
No, I think we should dive into this. Brandon, what is the first step that people need to understand when it comes to buying large multifamily property?
The first step is that I'm going to fire that question over to Brian. I know Brian's got the list.
Did I say Brandon, not Brian?
I think you did.
I think I said the wrong B word. Sorry.
Brian, what do you got?
So no accident that it's the same first step that we talked about in Volume 1, right? So if anything, at an even higher level. And that's commitment. So, if you just making the decision to, casually, I want to do multifamily, just that's not enough, right? You've got to have a level of commitment. So, while the income down the road, if you do this right, should be mostly passive, that doesn't mean there's not a lot of hard work involved. There absolutely is, especially on the front end. So again, you have to make that commitment. You have to want it. You have to be ready to put the time in. You have to surround yourself with the right people. And that requires commitment, requires hard work, requires sacrifice. It's not going to fall out of the sky, land in your lap. When you're not going to just the next day wake up and have a 200 unit apartment complex. It is, there is more to it. I'm not saying you can't do it, but just like in volume one, just like if you're buying a duplex, you're going to buy 200 units. You got to make up your mind and commit to it.
If I could add a piece here, you talk about this in the preface of the book. You mentioned this kind of story of how you gathered at this like mastermind with a bunch of other real estate investors. I think even more than small multi, if you want to get into large multi, I don't think that's even optional. I don't know of any large multifamily syndicator or investor who doesn't and didn't regularly surround themselves with others that are also doing the multifamily thing. I don't know why that is. And I'm sure there are the rare case out there, the Lone Ranger who's by himself doing this thing. But for me, for you, and for most people, they somehow got into a group of people who were doing that, whether they paid for part of that group, whether they went to a mastermind, whether they just had friends in the area that they got together and talked. But have you found the same thing to be true?
Absolutely. And you share a great story in volume one that's very similar. I think you were attending a conference when it happened to you. And for me, I had my very first multifamily mastermind, just being surrounded at that time with about 30 other very large multifamily investors. Those moments can be some of the most pivotal you could possibly have. So whether it's a mastermind or even starting at a local meetup or interacting with people on BiggerPockets, and I actually think even social media can be beneficial. What you want to do is just kind of get that stream of information and surrounding yourself, even if it's virtually, with people who are doing exactly what you want to do. It makes it seem more real. It gets you fired up. It helps with your mindset. And I think it helps with commitment.
I like that advice, because when it comes to where do I start with committing, it might just be as simple as commit to getting yourself around other people that are doing this and see what organically sort of comes out of that.
Put yourself in those situations and good things happen.
It's way too early to talk much about it, but something we're hoping to do here in 2022 at BiggerPockets is we're going to try in some more intentional ways at BP to get the larger, like the multifamily guys or the people doing dozens of flips every year, like basically like the I hate saying like higher level, but like the investors that are like the professionals, we're going to try to find some more frameworks and groups to get those people together more often within the BiggerPockets community. So I'm just teasing that right now. That's something maybe coming in the next year. That's kind of cool about that I'm really looking forward to, because there's just such value in getting around people who are just doing big things. And, I'm excited about that. I mean, that's why I started doing the Maui masterclass thing out here in Maui, right? So I could get around Brian. Like, I don't know if people knew that, but like Brian and I met because he came to my like mastermind, like out here in Maui, and we got talking, we got hanging out, and I got to see who he was. And I'm like, man, this guy's killing it. Or I should say he's crushing it in commercial and apartments. It's great. So commitment. Huge, and getting around people is a great way to get committed. So number 2, what else do you have for step number 2 in getting into the large multifamily?
Yeah. So in volume 1, we talked about your 3 C's, crystal clear criteria. And if anything, it's even more important when we get to large multifamily. So the depth of the criteria, some of the upfront research might be a little more involved. But we're starting with location, and everybody looks for different things, but there's certain things that you want to jump out and consider. And probably the first is to look for, consider local markets first, right? So I think that you can look nationwide, and we do with Open Door Capital, and I do. But certainly, all things given, all things equal, proximity does have its advantages, and that has a lot to do with familiarity with the market, the specific neighborhoods, where things are trending. So I always encourage people to start with that. And if it's not a fit for you, or it's, maybe the trends aren't looking very good in terms of population, job growth, those are some of the things that we look at very carefully. Then you can look further afield, right? Because when you're doing a large multifamily, you're not going to be out there, painting the sides of the buildings yourself, right? You're in the big leagues now. You're going to have a third party management company. And there's quality management companies that exist for large multifamily in most major metropolitan areas across the country. So, before you determine that market, I do think you look at things like I already mentioned, population growth, job growth. You could look at other demographics, the housing market. What's the average house selling for? We always look at open door capital. We're looking at crime, right? We don't want to buy in a sketchy neighborhood, or we know that there's going to be costs associated with that. It's going to be more challenging to rent. So you want to think about your location. You want to take a really hard look at the property, know what you want. The other thing, before I move on from location, like one thing we've been looking at more and more lately is landlord-tenant laws. Like there's some really alarming trends out there right now that are affecting large multifamily owners. It affects the small ones too. But when you're starting out and you're trying to address a location, I think it's a factor you need to weigh. Doesn't mean you can't be super successful in a market with difficult landlord-tenant laws, but certainly will make your life a lot easier if you end up in a state with more favorable laws from that standpoint.
Things like population trends, they matter, and all the demographic, all that stuff matters with small, but not as much. Like I don't care. I mean, honestly, this might sound even sacrilegious, but if I don't really care about buying in an area, like if I would buy a duplex in like an area that has a declining population. I'm not really worried about it as long as it's not like, people are fleeing it by like the millions, but like an area that's declining population, it hasn't been growing very much. As long as the numbers make sense on a duplex, triplex, fourplex, I'm not real worried, because I know that I'm a very like one deal out of thousands or millions of properties in the area. I'm not horribly concerned about those big macroeconomic things. But if you're buying a 100 unit or a 200 unit apartment complex and you're raising money and you're like, those things become really important. Because you're dependent upon your investors' monies that play here. And if the demographics of an area, if rent drops by $100 a month and you have 200 units in an apartment complex, that's a lot of money you're losing every single month there because you didn't pay attention to the trends. And that's one of the things I liked about Volume 2 a lot, Brian, is how much time you spend going into all of these things and why they matter. And I'll just point out one last point is a lot of people point out one last point. That's redundant. I'll make one more point. A lot of people will ask the question, well, what's the best real estate market to invest in? And that's a hard question because everything you just named here, Brian, right? Things like population and trends and employment-based, crime, demographics, housing market, supply, landlord-tenant laws, valuation levels, proximity to retailers, and all of that. And then knowing the fact that every area has submarkets that are better or worse than other areas. And so you can't just say this is the best market. It's got to be what's the best market for your criteria, right? It's what do you want?
Absolutely.
And now you can go and do some research.
Yeah, absolutely. Yeah. And the other thing that factor to consider is if you look at what the very best market are in the country, what are you going to find? Those are also the most expensive markets, right?
Yes.
So the ones that come out on top, unless you factor in valuation and you say, hey, everybody would love to have, apartment complexes in the hottest markets in the country, but your returns might be really low and the competition might price you out. And you might not be able to generate the kind of returns that you want. So you have to weigh all those things. And in Volume 2, we go through that in quite a bit of detail. And then, I guess the last thing to mention is just there's all these micro considerations. And I referenced neighborhood earlier. Every city, and most of the listeners already know this, but every city has a good area and a bad area and is trending in different ways. So you're going to do that macro look, but then you also have to look at micro. Like you actually want to walk the neighborhood. You actually want to, know what it's like at night, not just in the daytime, and see, oh, look, it's near a Starbucks, or it's near, it's near another higher end retail place. And then that, hey, those companies with all these highly paid, really smart site selectors analyze that, and they did some really hard work to figure out that's a really good location with a lot of promise, and you're kind of validating your choice. So lots of things to think about, lots of detail in the book to help you with that further. And then you want to look at the property, right? So you got to think about what type and real quickly, I'll just kind of share the list of the different property types in large multifamily. We have high rise, got mid rise, garden style, walk up apartments, manufactured housing, which is mobile home parks, which Brandon and I are invested in a lot of mobile home parks. And then you've got all types of like special purpose housing that might be out there, student housing, senior housing, subsidized housing is a whole nother area where you're, might be HUD housing or other types of housing that you're getting that's affordable, that's getting some type of government assistance for your tenants. That introduces a whole nother level of complexity into it. You want to think about what class of property, and so there's a whole classification system out there that's used, which is A class, B class, C class, D class, and that indicates different types of things about a property. And actually, there's similar considerations with the small multifamily. I don't know, Brandon, if you want to comment on the class types.
Just that, like, there are different class types, obviously, and so paying attention to them, knowing what you're getting into, and then knowing that, like, here's what I would say about, I guess, there's area class types, property class types, and tenant class types. And so the logic I usually make is the tenant you attract is going to be the average of the class of property and the class of like neighborhood. So if you're in an A class area, but you have a D class property, you're going to get like a B minus tenant. But if you have a B class property in an A class area, you're going to get a B plus or A minus tenant. So just something to be aware of as you're getting into this is that, like, there are classes of people, classes of properties, and classes of whatever I didn't say. You get the idea.
Yep.
Moving on.
Yep.
Moving on.
Absolutely.
Right.
So
the way that I like to look at multifamily versus single family, a quick way to understand it, multifamily is more powerful. You will make more money over the long term. It's like a battleship. It could just plow through things. But it also is much harder to change course with a battleship than multifamily, small multifamily, which is like a jet ski. You go the wrong way, you can shoot off to the side. It's not a big deal. That's why there's so much analysis involved in multifamily and why a book like this is so important. Because if you buy in a bad area, you've bought yourself a significant challenge for a long time that you can't do a whole lot to improve. And it's very difficult to get out of it. Just like a battleship, if it's going the wrong way, it takes a long time to sort of change course. So that's why it is so important that you understand what you're getting into when you go after an asset class like this versus, some of the single family houses that I buy, especially if I'm just going to rehab it. If I don't like what I ended up with, I'm like, well, I fixed it up. I made it worth more. I'll sell it to somebody else. And it's kind of, no skin off my nose or however that's said. So this is a very important book.
Yeah. I love that analogy, David. And, I always think of it as swimming upstream too. It's like you're trying to make a difference with the property. You're trying to improve it, raise the rents. But if the neighborhood around it is trending down and you're trying to trend your property up, it's, you're swimming into that current. So, I think of it in a very similar way.
That's a great point. It's a lot like being the one person in your circle of friends that's trying to improve your situation while everybody around you is trying to suck you back down to status quo. I really like that.
Yeah, absolutely.
Okay. Next step is going to be structuring. So properties like this are obviously more complex. There's more pieces involved, which is good. That's why it's less work because you have more people that delegate that work too. But that means structure now becomes important. Can you talk a little bit about what you've learned about the right way to structure these deals or how to do it?
Yeah. So, like one of the things we talk about in the book is something called a capital stack. And, it's capital stack is one of those fancy terms that people high up in the large multifamily field use, but it's really not that complicated.
Yes. You know what it reminds me of? Side note is when people say agency debt.
Yeah.
Or retrade.
Yeah.
Retrade's another one that sounds so much more cool than like when a single family person just tries to negotiate a better price based off the inspection report, right? Yeah. There's a lot of that in multifamily.
Yeah. And I love that you kind of, added on to that because I'll say right now, if any of you guys who are going to get out into the large multifamily space, don't get deterred by the jargon. There's too many people out there who throw that stuff around and they use it to kind of try to intimidate or make themselves sound smarter. they're not any smarter than you, right? They love to throw
Yeah.
those words around. And fortunately, we're gonna teach everybody about what all that jargon means, and you can throw it right back at them if you want to.
There you go.
So capital stack, it's basically the combination of equity and debt that you're going to use to buy the property. Where's the money coming from, right? So there's a lot of different ways, but in a high level, it's some combination of debt and equity, which is the cash that goes into it. And things can get, sometimes as you get bigger and bigger, there could be multiple sources of debt. There could be multiple places that you get that cash from. And if you kind of layer them all up, you say that's the capital stack. And the capital stack is usually ordered by the people who are kind of the safest and get their money first if something goes wrong. So on the bottom of the capital stack is usually that bank debt, and they've got the first rights, and then they have the least amount of risk, because if something happens to that property, they're going to be the ones that get paid off first. If they're made whole, there may be a second source of debt, and they're going to be made whole next. And then you've got someone who put in some cash, and then you might have someone else who put in cash under different terms. And so as you learn more about large multifamily, one of the things you'll be thinking about is, how am I going to pay for this? And what's that going to look like? How much of it's going to be paid through debt? How much of it's going to be paid with cash or equity?
Can you briefly describe the difference between debt and equity there?
Debt, any source of capital that you're going to have to pay back, right? So obviously the most common one would be a bank loan. But anytime you're going to use money to pay for your large multifamily that you're going to have to pay back at some point, that's debt. Equity is usually associated with some sort of ownership rights in the property, or the rights to the profits that are generated from that property. So the equity doesn't need to be paid back usually. And that basically entitles whoever's putting that money in to some type of either ownership stake in the company or rights to the profits that it's generating. So that's your equity versus your debt.
Can you give an example of, like, let's say there's a $3 million apartment complex. Yep. What would be an example of a capital stack, just for people who are still maybe struggling to put together the jargon into real world?
I'll use a real life example. There's a property that Brandon and I are working on right now, apartment complex in Colorado, and the capital stack has basically three sources. The first is bank debt. And so we're borrowing money to purchase this. I don't remember the exact percentage right now that we're going to use, but it's a loan from the bank. It's going to cover somewhere in the neighborhood of 75% of the purchase price. And on the capital stack, that would be on the bottom, because if anything were ever to happen, and we had to liquidate the property because it went into distress or something like that, that bank is going to get their money back first. Right. And then above the bank on the capital stack is the equity sources. And in this case, there's two levels, two different types of return structures. So that other 25% that has to be in cash, we're gonna raise from investors. Some of the investors are going to get preferred equity. And the terms for them is they're going to get a 10% return on their money every year, and all the way up until we pay them back the money that they put in. So that's like a preferred type of equity. So that's next above the debt. And then you have your common equity above that. Those people are going to get every year, they're going to get a 7 or 8% return on their money. And they can participate in the upside, because they're owners, and they could go, actually, if the property goes 2 to 3 times up in value while we hold the property, they could make 2 to 3 times their money on it. So they're going to get that lower return, but they get to upside. But the reason it's ordered that way in the capital stack is the preferred equity is taken care of first, and they're going to get their money back first. It's a 10% return, which sounds great, but they're not going to participate in the upside. So it might sound a little complicated. It's really not, once you kind of get comfortable with it and gets a little bit of experience with it. But that's a fairly straightforward. There's 3 levels in that stack, and you've got the debt, you've got the equity, 2 types of equity, all kind of layered in the order of who's taken care of first if things go south.
And here's where this gets, I'll add one more part. The next level up, I guess, I don't know if you call this in the capital stack, but technically, so the bank gets paid back first. Let's say it's at 75%, right? They get their loan back or paid back at the end of the deal. Then like you said, that first level of what'd you call it? The 10% people.
Yep.
Preferred equity. So they get their 10%, make sure that those people get paid their 10%. Then the next people get paid are the people who got their 7% plus they get let's just call it 70% of future. And that can change. And there's some complicated stuff we won't go into. And then after all of that, after there's a split, the GP, which would be, Brian, you and I, and plus all of our partners that are in this deal, get paid after all of that. And so people might think, well, this is really complicated. Is this all worth it? Yes, because we're buying a $30-some million property that we're going to turn much more valuable over time. It's going to go up in value a lot. We're projecting. And so everyone gets paid out their money. And if everything works the way we think it, we're going to walk with potentially millions of dollars at the end of the day. And I'm not saying like, wow, look at how great we are, but I'm just saying this is how great multifamily is, right? This is why we love large multifamily, is because we put all these pieces in order and now everybody wins. The tenants get a better property to live in and we get managed really, really well. It's kind of mismanaged right now. So they get a better property managed better. The investors they get the people who are more conservative, they get their 10%. The next layer gets a little bit lower, but they have more potential for higher. And then the GP is going to make a bunch of money. And it's like a win-win-win-win-win across the board. Everybody wins. And this is why I love and you know what? For all of that, Brian, you and I have to work overall, Open Door Capital takes a lot of effort as a big company, but on that individual deal, it's very little work. In fact, I would say it's more work for me to buy that duplex than it would be to buy this $30-some million apartment, which is why we love the large multifamily. Agree with all that? Does that make all sense?
Yeah. And it could be very rewarding to, a lot of people have that fear of approaching people and raising capital. But what I've found is it adds this whole other layer of self-fulfillment to know that we're going to make, we're putting ourselves in this position to make this opportunity to build wealth for so many people. And, it's one thing when you're doing it just for yourself, but when you can turn around and make a whole group of other people wealthy and make a difference in their lives, that's really rewarding. Cool, so it's not just about us, right? So it's exciting to think about everybody else who entrusts their money and puts in the returns they're going to get, potential upside, the potential to make a real difference.
Yeah, that's cool, man. Just put in perspective one more thing, then we'll move on to the next tip here is, think about this way. If over the next 5 or 10 years, you're listening to this right now, and you go buy $100 million of real estate, and you over the next few years, you turn that into, let's call it $150 million of real estate because you've added value, the rents have gone up, whatever. You just made 50 million. And that's not an absurd proposition. That's actually a very normal thing. Okay, fine. Maybe you only made $40 million. Now, again, you're going to split that with your investors, your investors, which we'll talk about here in a second. The people who gave you the money for that are going to get a sizable chunk of that, majority of that money. But you might still walk with $5, $10, $15 million at the end of that decade. Show me another business where that's likely to happen. You might build some, the next Starbucks, but that's so much less assured than multifamily real estate, than large multifamily. And so many people do multifamily, and there's so much content out there and step-by-step instruction like the Multifamily Millionaire books. It's why is everyone in the world not doing this? I don't know, but it's pretty exciting stuff. There's so much to be made by helping everybody win. All right, moving on. So that was number 3, I think, was structuring, but it kind of played with number 4, I know, Brian, right?
So my understanding, Brian, of what you said is you've got debt and equity, right? As the person who owns the asset, let's say that's Brian here, he's the general partner, you would prefer to give away debt versus equity. You'd rather pay an interest rate to the person lending you the money than you would give away equity in the property. So the majority of the financing for the property, say that 80% from the bank is done with debt, because that's better for you. Now you got to make up the 20% of the down payment. You could use your money or you could borrow it from other people. If you're borrowing it from other people, you're normally giving away equity. Is that a rough summary of what you're describing there?
Yeah, it absolutely is.
I wanted to clarify that's what we're talking about. Now, step 4 has to do with the way that you actually create the organization to support that model. Am I understanding correctly how you guys are doing it?
That's right.
Okay, so let's hear. What do you do when you're going to create this syndication? so that you're borrowing some money from the bank for debt, some money from investors for equity? And how do you determine who plays what role?
So, and this is part of the magic, right? This is one of those things that, when we talk about syndication, basically syndication is a way of raising money from investors to pay for your deal. And, I think that when Brandon and I both heard about syndication, and we were on different paths, heard about it at the same time, but we've talked about this, and I think both of us, and I definitely could speak for myself, when I first heard about syndication, it seemed so complicated. I know. And you talk about jargon. When people talk about different types of syndication, they're actually citing specific laws and regulations, and they're throwing numbers around 506B, 506C. And you're like, what are you talking about 506B? What is that, like an apartment number? Or, but that's a specific law. I still recall going to a mastermind, and I referenced in the book, and Brandon referenced it earlier, where I was with 30 other multifamily investors. And at that time, I was literally the only one in the room that wasn't doing syndications. And I was like, people ask me why, like, why aren't you doing it? And I came up with all kinds of excuses. I'm like, I don't know. But the truth was, I was intimidated by it. I didn't understand it. It seemed complicated. It sounded really complicated when people talked about it. And since then, I've learned that it's really not. So there's people, again, it's one of those things, you don't need to do it on your own. There's attorneys that can help you out. There's people that specialize in this. But basically what you're doing is you're forming a general partnership, and it could be one person, it could be multiple people who are raising the capital. They're considered the general partners. And you're going out and you're offering equity or participation in the deal to or ownership to the people who are putting cash in to help you do the deal. And so that allows you as a syndicator to potentially buy a large multifamily property without putting any of your own cash in to buy it. So if you want to talk about, is it possible to buy a 100 unit, a 200 unit, a 300 unit apartment complex with no money? It is actually possible. And syndication is how you do that. So high level, you're as the syndicator, you're the general partner. You have the liability. You're the one who's signing on the debt for the bank. But the cash is actually coming from other people who you're involving in the deal. They put the cash in, and they get a certain percent ownership and certain rights to the profits from the deal. And it could be structured in a lot of different ways. And there are securities laws around it that you need to get a basic familiarity with. Won't go into depth on that because it's all in the book. And
it's in the book.
But it's something you need to educate yourself on. The two most common, they call them, I just referenced them, but they're a 506B and a 506C. 506B is basically you don't. There's not really any. I think probably the 506B, the most notable thing about it is you can't advertise it. It has to be with people you already have an existing relationship with. And so there's some limitations in terms of, one thing to think about that you would say, well, why are all these rules and regulations in place? And basically, when you raise money from investors, it's almost like a stock offering. Like you're going out there and saying, I have an investment opportunity for you. And so that's why the SEC gets involved. Like they have certain rules. They want to make sure that people are not taken advantage of, and that they're knowledgeable, and that they can afford to make these investments. And so they have different guidelines that you need to follow. So if you're going to go out and publicly broadcast and try to raise money, then you actually follow a different set of rules, and you're going to follow what's called a 506C. And you're going to make sure that you're responsible about who you're borrowing money, or who you're accepting money from. And you have to have what they call accredited investors. And a third party comes in and verifies that they have the income and they have the net worth that makes them qualified to invest in your deal. The 506B, you have to have that relationship, but you can also accept money from non-accredited investors. It's like family or friends that maybe don't have that high net worth or high income, but you have to have a pre-existing relationship with them. So it's really not that complicated, but there is a lot involved, and you have to figure this out or read the book, and you can get all the information you need. So, but that's the beauty of it, right? So who would ever thought you could buy some large apartment complex without putting any of your own capital in? But it really is possible to do.
Yeah, if I could sum up just with an example, let's say there's $1 million property. The bank says, okay, fine, you can buy this $1 million property, but you're going to need $300,000 down. Okay, fine. You go get the $300,000 from some partners. They're the limited partners. They bring the $300,000 down, and they bring the money needed to fix it up if it needs money to fix it up. So you're doing this basically with no money. And I mean, we put money in all of our deals, Brian. You and I do, because we want to show our investors that we're committed. But there are syndicators who don't, and that's fine. But so basically, a $1 million property, your investors bring $300,000 of that money, and now the investors get a large chunk of it. Now, they don't have rights to like tell you what color to paint the building. They don't tell you all that stuff, but they bring the money needed. You manage the deal, and you just split profits however you define it. That's how I look at a syndication, right? And is that a good summary of like why a syndication is so awesome?
Yeah, absolutely.
And by the way, this same concept, just so everyone's aware, like I've said this in the last episode and this one, the game is the same. Duplex, triplex, fourplex, 200, 300, 400 unit property. You can do the same strategy. In fact, one of my very first properties was a triplex. I didn't have the money for it. The property was $50,000. We needed $10,000 down. We needed $20,000 for rehab costs. I needed $30,000. So I raised that from a partner. They brought all the money. We split the profits later on. Now we did 50-50 later on. Now most syndications are usually more like 70-30, but regardless, it's the same game. So anyway, syndication is awesome. And a large piece of the Multifamily Millionaire Volume 2 is about how to understand syndication. So we don't need to probably belabor the point here, but the point is it's awesome. You guys will love it. So maybe we move on to number 5. What do you got for number 5 tip or step here?
Number 5 is multifamily debt. And there's, like we referenced in the last episode, that there's some significant differences between small multifamily and large multifamily. But you can get some great debt terms for large multifamily. And that's another reason why I love multifamily, is lenders love multifamily, because lenders see that, hey, that's a stable investment and I'm not at high risk of losing what I lend. And so you can get some amazing terms from lenders on multifamily. But it's a different approach. And so what a lot of people do with the large multifamily is they engage the services of a mortgage broker. And so there's tons of mortgage brokers out there. And what they do is, these are people who are very familiar with all the different sources of money that you could borrow. And they know that, hey, they can look at the property that you're planning to buy and help you identify who the best people are out there to borrow it from, like which banks, which lenders are appropriate for it. And they know the whole lending process. So they can tell you what information they need. They put together a packet. And as you get more familiar with the process, you can assemble that in advance and take it to your mortgage broker. And they're going to put it in a form that the banks like to see. They know exactly how it's going to be viewed, and they can guide you through that. And in exchange, they take a fee when you close. So while there's several chapters that in detail outline the lending process, I think the most important thing to know is it's not something you need to navigate on your own. So it's not something you really need to be intimidated by, because there's an entire industry out there of people who are just waiting for that opportunity to go out and help you figure out how to place that debt so that they can get their fees.
That makes a lot of sense. And I know we could spend forever talking about debt, but I love that point you made there. There are people that do that. So, right, to bring them on your team, like understand the basic principles, read the chapters in the book, do the research. If you have further questions, Google it. But like, there are people who do this, but a mortgage broker should be somebody that's on your team. And speaking of team, I know that's number 6 are we on right now? Are you good to go? Yeah. Are you good to move to number 6, or anything else you want to say on the debt side?
Just that, there are multiple sources, pros and cons to all of them. And, like you said, you've got that person to help you figure it out. So, absolutely.
I really like how simplified you made that, Brian. The mortgage broker covers maybe 80% of the deal. And then you got to figure out how you're going to cover the other 20%. And that's where these syndication principles and stuff comes into play.
Mm-hmm.
It's really not as complicated as it sounds when we get into the intricate details.
Yeah, it's not. It's so great when maybe you might not even know how much debt you can get, but a mortgage broker can tell you. They can look at the deal and they can say, no, this deal, maybe you can only borrow 60%. And then you bring them another deal and they'll be like, I think I can get you 80%. And you don't have to figure that out on your own. So
that's a great point. I really like that. And I think that's just something I want everyone to, whether they're single family, multifamily, small multifamily, big multifamily, there's so much of, I got to know all the answers before, like my chiropractor example, thought he needed 20% down to buy a house in the Bay Area, which meant he would have needed around $180,000, $190,000, which takes a while to save when you've got educational bills that are coming due. Like there's people like me that exist that have mortgage companies. So people will go to us and say, what do I do? And we say, well, we'll give you this much. You got to come up with the rest. Here's an episode with Brandon and Brian talking about how you can go cover it. It's that taking that first step. It is not nearly as scary as what people think once you get the experts, which make up your team members, right? There's so many people are thinking they got to learn everything about real estate and they don't. You guys are a great example at Open Door Capital. You don't do everything. You have a whole team of people that specialize in the things that are there. So let's maybe talk about that. How do you build a team? What do you look for in a team? What is okay to expect somebody else to do versus what do you need to make sure you're doing to protect your investment?
Yeah, the first thing that I recommend is like do a really good self-assessment. Like try to get honest with yourself. Where are my strengths? Where do I derive joy? Even if I'm good at something, if I'm going to be miserable doing it, it's not necessarily what my role should be. And then I think from there, you recognize, hey, I've got some gaps to fill. And, Brandon, I think, you talk to this often. I'd love to get your take on partnerships.
Yeah. I am a huge fan of partnering. I mean, I have been since day one. I mean, my very first few properties, maybe like the first two, I didn't use partners, but almost everything else since then has been partnerships, just because I know I lack in a lot of areas. I know there's things I don't do well, but there are things that I do well. In fact, one of the reasons, Brian, like you and I started talking is because there's things that I've got the social media presence right now and the ability to raise, whatever, we raised $75 million in the past year and a half. Like I can drive a lot of that. But what I'm not good at is being able to talk to a mortgage broker about mezzanine debt. Like, well, I'm not that guy. But you can have that conversation and you look super smart. I walk in and they're like, hey, man, the shelter's down the street, right? Like there's two different skill sets that we have there. And so by partnering together, we bring the strength of both of us into one thing. And that's why, like, for example, the deal we mentioned earlier in Colorado that we're buying, even in that one, we're not the only, like, we're actually bringing two different general partnerships together, like two completely different companies. On that one particularly, it's Whitney Sewell, who is another fellow podcaster, and us are doing a deal together because they have things that they're really good at and we have things that we're really good at. So I love partnerships. It's just, it's like, yeah, you may have to give away half your deal or 2/3 of your deal or 90% of your deal, but can you do 10 times more by giving away 90%?
Yeah.
For most people, or twice as much by giving away 50%? For most people, the answer is always yes with the right person.
Absolutely. And how great is it that you could actually take your biggest weakness or something that you absolutely don't want to do and turn it into a strength? Like, and that's what partnerships will do. And I'll add one other thing here before we move on to the next step. But, I started off for the longest time, I didn't do any partnerships. I think for the first, 12 years in real estate investing, I didn't have any partners. And to be completely, transparent on that, I was lonely. Like it's a lonely road. Like, and when you've got partners, it adds a whole nother dimension that you have a shared experience. And I love the camaraderie. I love the partners I've gotten to work with and the relationships I've built. And there's something fun about playing a sport on a team, right? Keeps you accountable, keeps you motivated, and you can celebrate your wins together. And when things aren't going well, you can lift each other up. And so partnerships can be, that's the way to go. The bigger the deal, the more work and the more complicated it is, the more moving parts. And if you could tackle that as a team, it's so much more manageable. And frankly, if you get the right partners, it's so much more fun.
It is. I can 100%. I don't think this is talked about enough. We could do a whole episode just on this concept of like, it's so much more fun and profitable. I mean, like, think about it this way. You know, Mike Williams, who's one of our members on our team. And actually, when you buy the Multifamily Millionaire, the 2 books, you get a bonus content with an interview with Mike and Micah, another guy on our team. But let's just use Mike for an example here. So Mike is the friendliest guy you've ever met in your entire life. For everybody listening, if you know Mike Williams, you're like, yeah, that's like the nicest guy, the best guy I've ever known. Everybody loves Mike. And you know what Mike loves to do? Talk with people on the phone and talk about how awesome real estate is and talk about how awesome our company is and how good our fund is. He just thrives on that energy. You know what my least favorite thing in the entire world is to do is talking on the phone with people. I hate it. Mike loves it. And so what's great is like now we bring Mike in. Mike gets to do that role that he is the best person on planet Earth to do. And then we bring in Micah. He's the best person for that job. We bring in Walker, who's the best guy for that. And Jay and Tristan. And I'm leaving out half the people on our team, but everybody is so good at what they do that they're excited. They're having a good time. We do trips together. We chat. We get on the phone call. And everybody's an expert at their domain. And because of that, I don't have to do much like the stuff I don't like to do. And I'm having fun and we're buying 10 times more deals than I could have ever bought on my own, probably 100 times more. So anyway, I don't know. I'm driving that point forward, but
absolutely,
it's fun.
Here's what I would say to add some context. I hear a lot of people say, I'm working my job and I don't want to get into investing because I don't want to have to be a part of a team. I don't want to give up a portion of what I made because I keep all my money right now. And what they don't realize is they are already part of a team. By nature of having a job, you are working on someone else's team. You're playing a role in that business. You are not playing all the roles. What's your job? I'm an accountant. That's a tiny piece of that whole company that you are providing. You're on a team. So what you're saying is I'll play on someone else's team, but I don't want to start my own team and be a captain on that team and own that team. And that's what's so ridiculous about that fear-based, I don't want to share it. It's the sad thing is you're already on a team. You just don't own any of it.
If I could throw in one more piece and we can probably move on, but when I'm thinking team, and again, we go into each of these points in the book, but think about it this way. Like in a typical multifamily deal, somebody, and this doesn't have to be separate people. One person could do all these. Somebody could have 2 of these roles. Think of them as like a role or a hat you wear. So there's somebody in charge of acquisitions. They got to find properties. There's investor relations if you're going to be syndicating. They're dealing with the money from investors. You got a financial person who's dealing with the banks and the numbers and all that. You've got what's called a KP or key principal. That's somebody who's rich, basically. It's like a rich guy.
They're basically backing
right?
the plays that are being made financially.
Yeah. If you go to a bank, you want to borrow $10 million and you're broke, the bank's going to say no. If you go to the bank and you got somebody on your team who's got $1 million sitting in the bank right now, just sitting there, they're going to be much more friendly. So they're called the KP. You have an asset manager who's going to manage the property manager later on. And then you have somebody I like to just call captain. Like who oversees the whole thing? Who's the captain, the COO, the president, the CEO? And again, one person could do multiple roles, but when you start thinking, and I'm probably missing roles in there too. I'm sure you could probably add more like legal and accounting and other things. But if you think about multifamily, large multifamily in team, these are roles on the team. These are your quarterback and your tight end and your wide receiver. It's like, oh, well, if we had a really A player on each of those positions, like we could dominate the league and win the Super Bowl. Right? Anything you want to add on that, Brian, before we move on?
I think the only other thing is when you read the book, you'll see there's all different ways to have that, to assemble that team, to find that team, and some of them can be contracted out. You know, your team really, it might include your accountant, an attorney, a mortgage broker, et cetera, et cetera. So you don't have to necessarily have 8 people in your partnership. It might be 2. It might be 3, and you can have different types of arrangements, whether, in some cases it might be an employee or a general partner, or it could be a contractor. So the whole point is you're stronger leveraging other people's strengths than doing it on your own.
The Avengers started off with just a handful of superheroes. They added to them as they grew. That's a great point.
Yeah, that's great.
That's what I'm over here trying to build the Avengers, right? I'm trying to build out my teams because that's the only way you can ever accomplish anything big. So Thank you. That's a great point. All right. Next step, finding deals. That sounds pretty important. If you have all these pieces in place, but you have no deal to actually exercise them on, that won't help you. So what are the ways that you recommend people go about finding deals?
So things are a little bit different in the large multifamily world, but it really depends on the size of the property. So when we talk about large multifamily, like we talked about in the last episode, we might be talking about 50 units. We might be talking about 500. And so just like with small multifamily, you have off-market deals and you have on-market deals. When you can find an off-market deal for a large multifamily, you have this potential to get just an amazing opportunity. But the way it tends to work is the bigger the property, the harder it is to find that off-market deal. Why is that? That's because there's so much at stake in that sale that you've got just brokers all across the country working their butts off, trying to get listings, building relationships with the owners of the large multifamily so that whenever they think about selling, they think about that person who's been calling them every month for the last 5 years. And so it's much more challenging to find the off-market deals when we're talking about a 300, 400, 500 unit apartment complex. We're talking about a 50 unit, a 70 unit, a 90 unit. And even some of the little bit larger, you have a much more realistic chance of finding one that's off market, building that relationship. And in the book, we talk about some of the strategies that you go about doing that. So you could find that off market deal. It's great. But I would say that overall, brokers tend to be play a much larger role in the large multifamily. So one of the strategies is to really build those relationships. David?
Yeah, that's awesome. That's my experience that I've found is it's easier to find an off-market deal with smaller deals because there's less meat on the bone. And so there's less people chasing after that meat. There's not as many wholesalers out there trying to get that single family deal before you do, as there are brokers who know if I can land that a big apartment complex, I'm getting a huge chunk of money. So there's teams assembled for that goal. How do I have a relationship with those people? And I've seen many people make the mistake of saying, I'm just going to go around the brokers. I'm just going to email that person directly. Those owners of 500 unit apartment complex are getting lambasted with people that are sending them letters saying, I would love to buy your property, or I'd love to represent you. So because that's the case, the gateway often becomes that broker, and it's that much more important to have a relationship with them.
If I could throw in one difference also, a lot of times between the large multifamily and the small, is that the bigger deals, like the bigger properties, I should say, they aren't necessarily selling them because they're distressed. Remember in the first episode we did, or the last episode we just did about small multi, I said that so many landlords are terrible and they're mismanaging their properties and blah, blah, blah. In the large multi space, sometimes like the property's been performing great and they haven't been mismanaged. They're just at the end of their cycle, or their mortgage, their loans coming up
or
due,
their syndication was created to be done in 5 years. And so there's an unnatural event that they have to sell. Yeah.
Correct. So sometimes it's not like there's distress here. It's sometimes just like, well, yeah, it's just the right time for them to sell. They've maximized their return. They want to put their money somewhere else. And so, I was just going to add that sometimes then relationships, if you're building relationships with brokers, but also build relationship with other multifamily owners. In fact, I think one of the mobile home parks we're buying right now is because somebody knew that I buy mobile home parks and randomly found my phone number and called me, which always freaks me out a little bit when that happens, but they found my phone number online. Now I'm going to get like a ton of them. And they're like, hey, I got this mobile home park. Do you want it? And I'm like, hey, let's talk to my team. And I think that's actually one that we're buying, is because it was just like, they knew what we were buying. It wasn't distressed. They're not, mom and pop. They're another company who was just like, yeah, we're at this phase, we're ending. So let's save ourselves some broker fees and just sell it right to Brandon directly. And so the more you can network with other multifamily owners, also, you can sometimes get properties that way. That just makes sense. So.
And you also have, on top of the brokers, you've got wholesalers out there, and it's same theory applies. Like they're going to make a bigger payday if they land a bigger property. So, but like David said, right on the money. Like these people are getting hit up. If you own a big multifamily, you're getting hit up regularly from a lot of different directions. So that said, if you can manage to land an off-market large multifamily, there's possible. And I actually shared a story in the book. And that's probably one of the best ways to break into large multifamily is you find that great deal. there'll be a lot of people that want to start working with you or place money if you have that great deal, because they're so hard to find.
Okay. After finding deals, we're obviously at the step where we're going to have to figure out, what do I want to offer on it? Do I want to offer on it? And how should I make that offer? So what advice do you have for people that are at that stage where they are ready to write the offer?
So yeah, underwriting for a large multifamily, unfortunately, there's no way around the fact that, hey, this is a little bit more complex than the small multifamily, but it's doable. And the other thing is, there's some great tools out there that'll help you do that. So you don't have to be a math whiz. You don't have to be a professor to underwrite a large multifamily, but you may want to invest in some of the software that's out there and readily available. None of it's really that expensive, so it's worthwhile investment. If you're more mathematically inclined and you want to try to build a model yourself, you can do that. But what you have to do is very carefully look at you want to look at the rent roll for the property to see how much the tenants are paying. And then you want to compare that to what are other tenants paying in the same market and figure out, hey, is there room for me to increase that rent or not? You want to look at the expenses and figure out, hey, and we have guidelines in the book, the typical ranges for different type of expenses, and figure out, hey, is there opportunities here? Are the expenses unusually high? Can I cut them and create more value? Does it look like they're leaving common expenses out? So you can look in the book and say, hey, here's all the expenses that should be listed on the expenses. And if there's something missing, you have to add it back in. And then you're going to figure out what's my net operating income, which is the income minus the expenses. And that's what the value of the property is based off of. But what you're doing is you're looking at what's there now. You're looking at what the historically it was, so you can see how it's trending. You're applying some judgment about whether you have room to maneuver with your income or expenses. And then you're projecting, hey, what would my first year of ownership look like? What would my second year? And you bring that out into the future and figure out that from that's how you see what the increase potentially in that net operating income is and how much money you can make. And so what you end up doing, that will go back to that crystal clear criteria that we talked about earlier. One of those is, what kind of return do I need to get? And so if hey, for example, I need to get a 15% return in order for my investors to put money in, once you model out how much your income, how much your expenses, and your net operating, and how that's going to change year over year, you can then calculate what would that return be for everybody involved in the deal. Software can make that super easy, but that's what's going to drive your offer price, right? So you're going to say, hey, in order for this to achieve a 15% return, this is what I'm able to offer, right? So that's a little bit different approach than you take typically with a smaller multifamily, where you're saying, oh, this is the NOI. Now let's go ahead and calculate the value versus what they're asking. But you actually do it in return. With a smaller one, I guess I should say, you're looking at your purchase price and you're looking at what it's going to result. And then you kind of figure out, what's my return going to be? With larger multifamily, it's just a subtle difference, but you say, this is my return. This is what my offer price needs to be.
Kind of goes what we talked about in the last episode about small deals, and it applies for single family, self-storage. It doesn't matter. It's a real estate. Every property has a number that makes sense, right? So the way that this might sound too overly simplistic, but it really is kind of the simple, is we say, what kind of return do we want our investors to have? Like, how much money do we want our partners, our limited partners, to have? Okay, that's the number we want to achieve. Great. Work backwards. Boom, 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 boom. There's a purchase price. Right. And like that's right. It. And like, we go after it and we get 1 out of 10 roughly of our offers accepted. Yeah. And so we just make 75 offers a quarter and it tends to work out. Yeah. Like, it's just
another thing that people might be surprised who don't have experience with large multifamily, but most of the properties that come to market, they have no purchase price. They have no asking price. They say whatever the market will offer, that's the purchase price. So you actually, sometimes if you have a relationship with a broker, a lot of times they'll say, oh, they call it like a whisper price, or you'll say, you can ask the listing broker, is there pricing guidance? And they might give you a range of what they anticipate it's going to sell for. But a lot of people find that a little unnerving. What is very, very common with large multifamily that, yeah, this is for sale, but you tell me what it's worth. Go ahead and offer and offer. And it puts the burden back on you to determine, how much is it really worth to me? So a little bit different, but yeah, actually that underwriting step, it's something that can take a long time when you first get started to build that out. But the more you do it, it gets simpler, you get more efficient. We've got an Open Door Capital. We have our the person doing our underwriting right now is Jay. His name's Jay, and he's fantastic at it. And he's gotten to the point that, within a couple hours, he could tell you pretty accurately what a property is worth. If you're out there doing it for the first time, it might take you a few days of work to go through and really build out that, and figure out what you can pay.
Or if you're doing a mobile home park and the owner doesn't even know how many units he has or what rents are, So here's the thing about underwriting that is, again, very different than what I think people think. I think people think of underwriting as plugging numbers into a spreadsheet. That is maybe 2% of what underwriting is, because the difficulty is finding the numbers. Yeah. You can put numbers in a spreadsheet. Anybody can do that, right? You could have a 5-year-old kid saying, put this number into spot C7. But it's the deeper question of what are rents actually at right now? What could they be? Or what do we think the future is going to hold for this property? Or what could the water bill be next year and the year after? So it's making those, and it's a lot of assumptions, right? We're making a lot of assumptions when we underwrite, but that's the best you can do. You do your best. And this is why it is so important to understand your crystal clear criteria, to have your niche. This is what you do, because the more deep you go the mile deep on a certain niche or a certain type of real estate or multifamily in a certain area. And you can now make those assumptions a lot better versus if you're just looking everywhere all the time, you don't care what you buy, you'll buy any kind of real estate deal. How do you know what assumptions to make? But once you've analyzed 100 of the same apartments in the same area, you're going to be way better at that. So again, start with your criteria.
Yeah, and you need to tour the property, right? So a lot of your numbers are going to come from what you see while you're there, right? So if you're going to say, is there room to make improvements in this property? And you have to figure out what that would cost. You have to figure out what you could charge if you fixed it up. And one tip that I would offer is that having that third-party management property involved during underwriting, that's just priceless, right? That can take a lot of work off your plate. If you build a relationship with a property manager who already knows the market, is probably managing competitive properties there and knows what the market will command for 1 bedrooms, 2 bedrooms, 3 bedrooms in that part of town, for different levels of finishes and things like that. A good property management company will help you immensely with your underwriting, and they'll even look at your numbers and give you feedback on whether they think it's realistic. Property management companies, they're also the ones that know, hey, what is labor costs? How much should your maintenance be in that market? For a typical, say, C-class 30-year-old property, what's reasonable for your repair and maintenance number? So that's just I think a really useful tip. If you can, we talk about building partners that are third parties. Property management company, if you find a good one, is priceless.
I love it, man. I love it. All right. Well, we got to get out of here in just a short bit. So let's move on to the last 2 tips quickly and just hit them. We don't have to spend a ton of time. We got due diligence and asset management. You want to talk about those briefly?
Yeah, sure. So you go ahead and you get that offer in, and if it gets accepted, you have a certain amount of time to do due diligence. And this is basically where you're saying, hey, I want to make sure that this car that I'm going to buy is actually everything I think it is. You got to look under the hood and maybe, have the mechanic come in and check it out. Again, you could have that property management company come in, walk the property, dig it, actually walk every single unit, and really dig in, maybe audit some of the financial information they gave you. There's third parties that can help you do that. Some of the stuff might sound real complicated, but if you're noticing a theme throughout this podcast, it's that, hey, you don't have to do it alone. There's people who are experts in practically anything that sounds overwhelming. So yeah, due diligence, you want to be thorough. You want to, this is where you really dot your I's and cross your T's and say, hey, before I actually close on this property, I want to make sure everything's in order. And then asset management comes after the closing, right? So you go through your due diligence and then you have your closing, and now it's time to run that property. So there's a lot of aspects to that. You're going to rely heavily again on a third-party management company. And this is where you start to execute and look for ways to drive up that revenue, manage expenses. You hopefully will have identified some of that ahead of time, but you still need to execute on it. I think personally, one of the parts of Volume 2 that I'm most excited about is the value add parts. So there's an entire chapter on different strategies to add value, and we talk about repositioning the property. But then in addition, there's actually 3 fairly detailed long supplements about all types of tips and tricks to how to drive up revenue, how to add ancillary revenue like laundry and different types of sources besides just rent. And there's an entire supplement on how to cut your expenses on a property. And this is something that when large multifamily investors get together, they love to hear all those tricks of the trade. How do you drive up that NOI, which is what, that's how you improve the value of the property and get your return. There are well over 100 tips and tricks in those supplements to hit that NOI. So I'm super excited for, the readers to be able to get in there and use some of those tips to make themselves a lot of money.
I notice everybody wants to lose weight or gain muscle. Nobody wants to maintain the weight they've lost, or they want to, but it's very difficult. We don't put effort into understanding that hitting that goal is not the end. It actually is the beginning. And I feel like asset management is the maintenance of the goal you set. You wanted this property. You wanted it to provide money. You wanted financial freedom. You wanted whatever. You've got it. If you don't manage it right, it's like hitting your weight loss goal and then going right back into being overweight or gaining muscle, and then it atrophies. So many people ignore this component as if once you get to step 9, you're done. But this might be the most important component of all, because you put a lot of money and a lot of time, a lot of effort, a lot of everything into this thing. And if it's not managed well, you lost it all. So that chapter has got to be wildly valuable when it comes to people that have said, hey, I did it. You're like, great. Now the journey starts. This is how you maintain it. Because just like everything else, if you take care of real estate will take care of you. But if you don't, it's not a magic pill. It actually becomes a problem.
Yeah, I couldn't agree more, David. You're absolutely right. So many people, they leave that closing table and they feel like they crossed the finish line. And what you really did is you crossed the starting line. It's the outcome of that property and whether you're going to make money and be successful. That's day one. Is closing. So, and that's not to say everything leading up to it isn't important. Of course it is. But, now you're in for the long haul. This is where, where you can really play out and make a difference. Are you going to generate fantastic returns, make a lot of money, make all this worthwhile, build generational wealth for yourself and your family? Like, this is where the rubber meets the road. So, very well said.
Yeah, this has been a phenomenal episode. I know we got really deep into the large multifamily. If you're still listening to this thing, that means you are a rock star, and I can't wait to see what y'all do with your large multifamily. Now, we're not quite ready to get out of here. I want to ask the one more question of you, Brian, and then move on to the famous 4. But the last question I got for you is, if you could really narrow it down just one piece of advice for people who are right now, they've been in small multifamily for a long time. They've been, got some single families, maybe they've done some flipping, whatever, and they're thinking, you know what? I want to do what Brian did. I want to do what Brandon did. I want to do some syndication or some big deal. What's the one tip you can leave them with?
I think, and I guess this would be, probably one of your final 4, but, I just can't overstate the importance of the right mindset going into this. And you could point to a lot of different attributes that you need to demonstrate to be successful. But, I would say the longer I've done this, the more I've realized that having that mindset of, really believing in yourself, level of determination and grit to get it done. Like it's all about your mindset. And so, I would say focus on that. And we already talked about ways to achieve that. Surround yourself with other people that are doing what you do, and think about your purpose. You got to want it.
I love it, man. Well, thank you. And with that said, let's head over to the last segment of the show. It's time for our Famous Four. All right, the Famous Four, the same 4 questions we ask every guest every week. And before I ask the 4 questions to you, Brian, or we ask them to you, I do want to say real quickly, I've mentioned it earlier, but I'll say it again now. The Multifamily Millionaire Volumes 1 and 2 are available now for ordering and for buying, and we're going to ship them to your house. It's also available. We have the audio version on BiggerPockets. You have the physical. You've got the digital. You got all that stuff, and you can buy them on BiggerPockets. It's not that expensive. Like, honestly, for the amount of information you get here, it's over 700 pages of total content between the 2 books, plus hours and hours of bonus content, white papers, the mindset thing, plus the 4-week masterclass that I recorded back in July. I recorded a 4-week class on multifamily real estate, and people absolutely loved it. You get that as well if you order before the end of August. So all of that you can get at biggerpockets.com/multifamilybook. Again, biggerpockets.com/multifamilybook. Get that and more. And then take a picture of your book when you get it in the mail. Put it on Instagram. Tag us. I'm Beardy Brandon. Brian, what's your Instagram handle?
Crushing It Brian.
Crushing It Brian. And of course, you can take David Green just for the heck of it at David Green 24.
Just for the heck of it.
Just for the heck of it, because we all love David. Question number 1 of the Famous Four. Other than your own, what's your favorite real estate related book?
So I don't really have a specific real estate book that I end up going back to, but I always like to give a shout out to Steve Burgess' apartment investing book, because back when I first got started, I found that to be the most helpful for myself. I mean, it's been out for a really long time, but if I was to point to one that kind of really got me going in multifamily, that's one of my favorites.
When we wrote this, I think we even said that we're our goal is to write a better book than that one and a few others that are really popular. Anyway, I hope we did, because there's some good ones out there, but hopefully we're going to be added to that list. We'll see. Next question. What is your favorite business book?
I read a ton of business books. My my favorite business book tends to be the one I read the most recent.
Same.
But there's one I read last year that most people haven't read that I really enjoyed. But I'm a big fan of Charlie Munger. He's Warren Buffett's partner. And he wrote a book called Poor Charlie's Almanac, and it's just loaded with, I'm really always been a fan of value add, and Charlie Munger is really into value add investing. And even though we're talking about stocks versus real estate, like, I just found the stories in there really compelling, and that I could really relate to it. And he's just one of the most wise people that I've ever come across. So give a shout out to Poor Charlie's Almanac.
Next question. What are some of your hobbies?
Well, my biggest, more recent hobby is I started trail running last year, and I'm living in the Atlanta area now, and that's relatively recent for me. And I found that I really love to get up in the mountains and start running on trails, and that just grew. And I spent more and more time doing that, and sort of culminated a couple of months back when I did my first ultra marathon out in Oregon at a place called Smith Rock. So really enjoy getting out into nature, putting the electronics aside and tuning out for a bit, and getting out there and hitting the trails.
If anyone has not done trail running, I can't hype it enough. I never thought I'd be into it. I mean, I run because I have to, but I never liked running. I like trail running. It is fun.
Yeah.
I don't know how to describe why it's so fun. It might be a combination of having to look at the ground. So you're not focused on how tired you are. You're looking at the terrain and looking out for rocks. And there's a bit of a, go ahead, Brian. Oh
yeah. No, I was going to say that I think that's a lot of it, because if you don't focus on where you're stepping, you're going to take a dive, you're going to take a spill. And to me, it helps you clear your mind, because it forces you to, like, all the other distractions go away. Mm-hmm. And plus you're out in nature, and that feels good. So
thanks for sharing that. Brandon, you're up.
Last question. What do you think separates successful multifamily real estate investors from those who give up, fail, or never get started?
Yeah, so I'm going to go back, not to like raise it too many times, but I really feel that mindset, a focus on mindset, and making sure you're constantly in alignment with where you want to go in life, and believing in yourself and doing that. And so certainly if you purchase the Multifamily Millionaire from BiggerPockets and you get those bonus materials, absolutely worth the time to listen to that discussion about mindset with Jason Dries.
Yep.
And Brandon, maybe you could add to that.
No, I mean, I just think that mindset is the number one most important driver of almost any success in anything. I'll give an example. We interviewed a guy in the podcast a long time ago who flipped 100 houses his first year. And when asked how he did that, very first year of investing, he said, I didn't know that's not the way you're supposed to do it. And it was such a telling story because it just shows that he didn't realize you're supposed to do one house at a time and you're supposed to start small. I mean, supposed to, I'm putting in quotations here, right? And so he just started bigger. And so it's the mindset you start at will determine the level at which you play at. And if you start at a higher level and you work on your mindset, improve your mindset, the results that you get, because your actions change, and everything changes. So your mindset changes your actions changes your results. So take time to work on your mindset. It's vital. It's so important. So yeah. And I love that, Brian, you and I are on the same page on that. And I think that's why we make good partners.
Last question of the day, Brian, where can people find out more about you?
Yeah, so feel free to reach out on social media. You can find me at Instagram at Crushing It Brian. You can find me on LinkedIn, Facebook. So yeah, I'd love to hear from people.
Awesome. And of course, get the book at biggerpockets.com/multifamily book. Learn more about it there. We've got lots of good testimonials and stuff that have come in. So I think people like it, and I think you will as well. So thank you everyone for listening to the show. Brian, thank you for being an amazing partner and an amazing human being. You're the best.
Thanks, man. I appreciate you.
This was a crazy good podcast. We could sell this as a course if we wanted. That's how much information you guys gave about all things multifamily. Man. If the book is 10% as good as this podcast, it's going to be a bestseller. So great job, guys. You blew me away. Let's get out of here. This is David Green for Brandon, the Multifamily Millionaire Turner, signing off.
You're listening to BiggerPockets Radio, simplifying real estate for investors large and small. If you're here looking to learn about real estate investing without all the hype, you're in the right place. Stay tuned and be sure to join the millions of others who have benefited from BiggerPockets.com, your home for real estate investing online.